Jim Cramer, and welcome to my world.
You need to get in the game.
Firms are going to go out of business, and he's nuts. They're nuts. They know nothing.
I always like to say there's a bull market somewhere, and I promise
Mad money. You can't afford to miss it. Upon further review, the ruling on the field is overturned. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. So my job is not just to entertain you, but to educate you. So call me at 1-800-743-CNBC. That booth review, that result, is how I felt all day as the Dow roared a beautiful 109 points higher. The S&P vaulted 0.58%. NASDAQ launched itself up 1.04%. Quintessential Monday quarterbacking job. I spent much of the weekend, loser that I am, puzzling over how the market could be so wrong about the earnings we saw last week, reacting negatively no matter what, to what I thought were some pretty darn good quarters. Maybe the markets were blindsided by some gigantic linemen who hid the true picture of what's going on. Or perhaps the market was confused by the excellent acting of the Bears, who put on a really, truly terrific performance. Not the Chicago Bears, but the tougher investing ones who don't take themselves out of the game because they have knee boo-boos. None of that matters now, though, because the market ref is back from the review camera. And here's what he saw when he looked at the tape of last week's games. First, regardless of what you may have heard, the earnings this season have been absolutely tremendous. Despite the folly of reading the papers, oh, is that ever folly, which were filled with endless gloom about how raw cost inflation is going to wreck the year. That's the new 2011 theme. Well, let's just say fully 65% of the companies that have reported so far have managed to beat the already dramatically heightened expectations. That's pretty incredible, given that, well, the bar had been set so high already. Second, we've been told over and over again by the saturnine, sarcastic sirens of skepticism that it didn't matter how good earnings were. The earnings numbers were all supposedly manufactured by CFOs, chief financial officers, through aggressive firings and increases in productivity. We were told over and over again, until we saw an actual rebound in sales revenues, it just didn't matter. Well, all last week, we saw spectacular sales growth, the best in 3 years, and still getting stronger. That tells us companies are doing well, because there's actual demand for the goods and services. That's not engineering. That's not those bogus beats with cost cuts anymore. Third, we've been conditioned to think that the only game in town is our friends in China. But you know what? We got a lot of good news out of the United States last week. As the quarter progressed, each time what we saw is, whether it be from Union Pacific talking about traffic pickup, CSX tonight, stop trading, including key auto sector, or from Alcoa, AA, which is talking about the possibility that commercial construction could be coming back from the dead in the United States. So maybe it's time to get re-educated. And remember that the U.S. is still the largest, most powerful economy on Earth, one that's getting stronger and stronger. And this is before we see big job growth. Of course, China didn't raise interest rates this weekend. So we had a lot of short sellers banging their heads against the walls when they didn't even get that big, bad event they were so looking forward to. Something that they would have expected, right? And that would have caused prices to come down dramatically if the Chinese had tightened. Fourth, while we have higher raw costs for certain, they're manageable, not the death knell to the market, as the media keeps claiming. For example, Cramer fave specialty chemical player PPG, Chuck Bunch, based in Pittsburgh, he must have been happy, told us that the cost can be passed on and that the price increases are sticky, even as key raw ingredients like natural gas haven't gotten any more expensive. And that gives the company better gross margins. That's going to be a continual theme throughout the earnings season. Fifth, Apple. Now, if you recall, I postulated last week that if Apple sold off after perhaps the single most explosively fabulous quarter I have ever seen from a company, one that could transcend the hopefully temporary departure of Steve Jobs, then it's hard to figure what other stocks wouldn't sell off after earnings. I mean, it was that good. If the best quarter you have seen yet can't generate any upside. You can only imagine what earnings misses will do. Well, voila, the lid was removed by Apple's astounding $10.73 move up in today's session. 6, companies that failed to react positively or just plain got hit on good quarters are reacting the way that Alcoa did today, starting to rally hard. Alcoa's quarter stood out as a huge change from the past, with amazing cash flow and phenomenal prospects for 2011. Yet the stock got hammered. Why? Well, it had rallied some 30% ahead of the quarter, but people said, hey, maybe it wasn't so good. Now it's putting those points back on. Same with Schlumberger, putting points back on the board, which is what you want to do. Schlumberger reported a terrific number, but got hammered mercilessly, like it was some sort of miss or something. Rallied terrifically today. Intel, which is now almost back to where it was when the chipmaker reported that so-called disappointing quarter, and we did get an actual disappointing dip. It rallied 2% today. That's an excellent sign of a market that's more comfortable, more thoughtful than we want to give it credit for. And it means you probably got to go right now. I'm calling it. This is my called shot for the day. I'm saying you should probably buy some Skyworks Solutions tomorrow. Another stock that got knocked down after a truly terrific quarter. Because if I'm right about the delayed reaction to good news and the further booth reviews, Skyworks will be taking out its $33 high on the strength of all that Apple, iPhone, and iPad business. Finally, there's the GE effect. On Friday, General Electric reported a quarter which showed strength in all, well, oil service, locomotives, large health equipment, gas turbines, aerospace, and media, which also showed dramatic improving credit quality. Remember, GE has that huge financial business. We've forgotten the General's power to lead. In a different time, you could predict the direction of the whole market just by listening to the GE conference call and then watching the direction of the stock. I think General Electric's latest quarter amounted to a reset of the old clock, which is something that's appropriate given the overturning of the market's call from last week. No wonder the stock touched 20. I think the next stop's 23. Here's the bottom line. Unlike football, we don't put time back on the clock, but we do readjust the points the market gives you. So the challenge worked. The Bulls will not be charged for a timeout. And we have a definite momentum shift that's put the 12th man back on the field while the cash is coming in from the sidelines. Michael in my home state of New Jersey. Michael.
A big booyah, Jim Cramer.
Stuttering Garden State booyah back at you, Chief.
Hey, Jim. I got a question about Salesforce.com.
Yeah, it got hammered today.
It did. And I bought some back on October 6th. After I had a big sell-off, I picked a few shares up for $102 a share. Then it rallied up to about 151 on December 9th. And due to the high PE right now, I'm just wondering if I should hop back in or if I should wait a little while longer.
Look, this market doesn't like high PEs in the wake of the F5 disappointment. There was a very negative article apparently this weekend about Salesforce.com and about the margins. I doubt that. Mark Benioff has repeatedly delivered. But you know what? You have a position, you don't need a new position. This is Salesforce.com is the kind of stock right now that's under pressure. I'm doing a big thing tomorrow about the high multiple-itis that this market has. It likes lower multiples like IBM, not Salesforce. No need to pull the trigger right now. A better time will evolve. James in Missouri. James.
Hello, Jim. Thanks for taking my call. I enjoy watching the show.
Thank you, James. Thank you.
I'm from the Show Me State, so please show me the way to go.
All right.
I bought MEMC about 2 years ago. I'm down 21%. I have plenty of tech stocks in my portfolio. I have a pretty well diversified portfolio, but I have no material stocks in it. In your opinion, is MEMC's time coming, or should I sell MEMC and buy an Alcoa?
I liked MEMC when oil went up because it's a solar play. I did not like it when they had their top resignations, and that caused me to be able to say, wow, maybe I'm too aggressive. Alcoa is going, I think, to 22.23. It's one of the largest positions I have in my Travel Trust. You can follow that along at actionalertsplus.com. I think Alcoa is 10 times the company of MEMC. Upon further review, the ruling on the field is overturned. We have a definite momentum shift. The cash is coming in from the sidelines, and I think this market may be primed to score. Mad Money's back in.